I'm going to do today's report in video format again. I want to look at what I think is going to be the surprise of next year. Clearly, the surprise of 2017 was the dollar. At this time last year, most people were anticipating the dollar was going to continue up, maybe as high as 120 or higher, and instead the dollar dropped down to 91. So the big surprise last year was the move opposite of what everybody was expecting in the dollar. I think that's going to continue yet again this year. I think the dollar has started a bear market, and I think this very weak bounce out of this yearly cycle low, I think it has already topped. Couldn't even make it up to the declining 200-day moving average. We have shown you this kind of a megaphone pattern that has formed in the dollar before, and once this intermediate cycle breaks down out of this megaphone pattern, I'll show you the chart of the euro here in a minute, but I think the dollar's probably going to go back down and test this 2014 three-year cycle low, maybe during this next intermediate cycle. And I think the new bear market in the dollar is going to drive pretty much all asset prices higher. It's already driving the stock market higher. You can see here we started this bear market at the beginning of the year. I'm going to put the S&P up here. You can see what happened at the beginning of the year. As the dollar has gone down, the stock market has basically just gone straight up. So I know a lot of people think that it's just too late in this bull market for stocks to have much upside yet. I think what very few people are taking into account is that the dollar has started a new bear market. I think it's going to be a very destructive bear market in the dollar, and I think that's going to push all asset prices higher. And since the stock market is the asset that is in the clearly defined uptrend, I think most of that pushing will occur in the stock market to begin with. But I think gold, oil, and the rest of the commodity markets will also continue to climb and maybe start to accelerate as we start to get some fear in the currency markets as the dollar decline starts to become unruly, possibly sometime later in 2018. Moving on to the euro, you can see we've got a major resistance zone right here around 120. This is where we got that pullback, but again, it's been very, very mild, and the euro is holding above this 200-week moving average. And I do think this was our intermediate cycle low right here. This was a very stretched intermediate cycle. I think we are now starting a new intermediate cycle, and I think this one is going to break through this resistance. When it does, there really isn't much in the way of resistance until we get up here around 139, 140 on the euro. So that's why I believe we're probably going to see the dollar make a beeline towards those 2014 lows, right around 180, or I'm sorry, around 80 in the dollar index once the euro breaks through this resistance. So let me convert this back to a daily chart. All right, so we've got the real intermediate trend line was right here. You can see we broke that, but just for good measure, we've also broken this intermediate trend line. And I've been saying that I think the ECB will try to keep the euro suppressed. They're not going to want the euro rising, but I just don't think they're going to be able to stop it. And so far, the euro is holding this breakout above this secondary trend line. And here I've got a more of a closer look at the dollar index, and you can see here if we assume that this is one really long daily cycle, then we have now broken the intermediate trend line in the dollar, which would be another confirmation that this intermediate cycle has rolled over. And we would presumably have a lot of weeks left yet before this cycle would bottom. It should break below this intermediate cycle low here as the cycle is left translated. So, and this is the wild card when it comes to the gold market. Gold is getting a little overbought, and sentiment is getting short term anyway is getting bullish in gold. But the wild card is that this daily cycle is rolling over in a left translated fashion, and we're getting late enough in the cycle to where we could really start to accelerate lower and break below this low. So that could keep gold rising even despite the overbought conditions and the rather bullish sentiment. Moving on to the stock market, we're starting to get kind of late in this daily cycle as well, and I don't really think we're going to break down here. Maybe we will, and we'll get a normal decline into a daily cycle low here in the next few days. But then I think because this cycle is forming as right translated, my guess now would be that we would require a third daily cycle before stocks could find their next intermediate cycle low. So my preferred scenario would be for the stock market to break out of this flag pattern here and give us that final push that takes us up to 25,250 to 25,400, and then we get our T1 pattern that comes back down to test this consolidation zone right here. All right, so I've outlined this for you. So here's the consolidation zone here, a little above 2300 to 23.6, let's call it. My preferred scenario was a continued push up to above 25,000 and then a return back down to test this consolidation zone. But we're starting to get kind of late in this daily cycle, so it is conceivable that we get maybe just a push to 25,000, have to come down into something that's recognizable as a daily cycle low, and then the push up to 25,250 or a little higher, and then the intermediate cycle decline. If that is the case, we're probably going to move that ICL out to late February, maybe even early March, if we're going to require a third daily cycle. And it's starting to look like that may be the case here. This is the bull market channel trend line. I've shown this several times before. The S&P is holding above that trend line. But we have pulled back from this even number 2,700. But I don't think that's going to offer too much resistance here. This just looks like a mild flag pattern to kind of catch its breath, and then I think we're going to break through this with one more leg up. Now the only question at this point is whether or not this drops far enough to give us something recognizable as a daily cycle low, and then we have to start a third daily cycle. This may boil down to whether or not this trend line gets broken here. We're on day 28, so we're getting late enough to where we could over the next, let's call it maybe 7 days, break this trend line and come down far enough to where we could get something that we could recognize as a daily cycle low. And then at that point we would be somewhere around 35 days into the daily cycle, and then possibly that would be the point at which we start a third daily cycle. We break above 2,700, and the Dow makes it up above 25,000, and that gives us our intermediate cycle top. So it's starting I'm starting to lean towards that scenario. And if we break this trend line, say Thursday or Friday, then that may be exactly what's going to have to happen. Another mild daily cycle low similar to this one, and then a third daily cycle. Moving on to energy. Again, I'm going to caution some patience. Oil has managed to reach that $60 level, but we've still got some room here to the upside. As high as maybe a little over 62, 62.59 looks like. So I don't think you need to be in a big rush to try and short oil just yet. We've still got a little more room to the upside here before we're really going to push deeply into this resistance level. So when I think we've gone about as far as we can go, then I will make a portfolio change for the energy portfolio, and we will get short one of the oil ETFs. Definitely not the energy stocks. I'm going to actually trade oil, so it'll probably be maybe one of the triple leveraged short oil trades when I'm ready, but I'm not ready just yet. We're kind of in just the lower part of this range, and we've still got a little bit of room here for the upside before we're going to hit the top of this resistance zone. So just stay patient here. I don't think we're ready quite yet. Moving on to the metals. At this point, there's just no denying that we've finished the intermediate cycle low here. And even though this was a left translated intermediate cycle, it's still held above the July low, well above the July low. So July becomes our yearly cycle low. So the yearly cycle has migrated from late in the year, the last several years. So 2015 late in the year, 2016 late in the year, 2017 the yearly cycle low migrates to summer, and the ICL in December is just a run-of-the-mill ICL. And the right translated intermediate, the left translated intermediate cycle fails to push below the July low. So very constructive pattern here. Higher lows. See this low, 2015, 2016, curves above. The year previous, this yearly cycle low well above the 2016. This intermediate cycle low above here. And we've got a dollar that's 21 days into its daily cycle. It's getting deep enough to where we should start to get that strong push down into its daily cycle low. Let me switch this over to the dollar real quick. All right, so this daily cycle is becoming mature enough. We've broken this secondary intermediate trend line today, deep enough in the daily cycle that we should get a push down and confirm this left translated cycle with a move below here in the next several days. And so going back to gold, despite the fact that gold is getting pretty overbought, sentiment is even getting quite bullish on the short-term sentiment. But if the dollar really starts to move down aggressively over the next week or two, then gold could just continue to move higher here. So again, I'm going to warn people that this first daily cycle, especially the way the currency markets are set up right now, it could be very dangerous to try and think that you are going to be smart enough to time the wiggles in this first daily cycle. I think there's a very good chance that gold could test this intermediate cycle high up here around 1360 before this daily cycle tops. So I wouldn't pay too much attention to the overbought conditions or bullish sentiment levels right now. These can be alleviated with one or two down days, but the overall daily cycle still very young. I think this first daily cycle still has a long ways to go. Very possibly we can test these all-time highs before this daily cycle tops. So I don't think you want to try and trade in and out of this market right now. I think you want to just hang on and see where we get to by let's call it within the next 2 weeks. The dollar's probably going to put in that daily cycle in the next 5 to 10 days. So gold could easily continue to rally for another 5 to 10 days or longer. First daily cycles, I have seen them rally 30 days before the daily cycle tops. So we've got a very strong rally, sliced right through the 200-day moving average on its first try, sliced right through this intermediate cycle downtrend line on its first try. Just not a market that you want to mess around with, and you definitely don't want to try and short this. A quick look at the miners. You can see again, just like gold, sliced right through the 200-day moving average on its first try. It sliced through this peak right here, this resistance zone on its first try. It's holding it today. Moving on to the juniors. Same thing, sliced through the 200-day moving average, first try. It has moved very quickly above both of these peaks. I don't think it's unreasonable that the juniors could test this intermediate high before this daily cycle tops. So to end, I'll just point out one more time, the surprise from last year was when everybody was expecting the dollar to continue its bull market. The Fed had stopped QE and the Fed was raising rates. The dollar did the exact opposite and has started down into what has all the appearances of a new bear market. The Fed is not raising rates anywhere near fast enough to stop the collapse. And I think 2018, the surprise is going to be the exact same one that occurred in 2017. The dollar is going to continue lower despite the Fed raising interest rates, despite the Fed having ended QE and Europe holding interest rates negative and continuing their QE programs. The damage has already been done, and now the Fed, they need to be raising rates extremely aggressively to stop this collapse. I don't think they're going to do it, and I think the surprise is going to be just how far the dollar falls in 2018, and I think it is going to drive all markets higher, which it already is. Gold completed its bear market in 2015, has been moving up ever since. Granted, it's been in a basing phase all of 2017, but during this move down, the stock market has been in a very aggressive move higher. Oil, a lot of people expecting oil to go back down to $20 or to $30 or lower. Instead, it's now testing $60. I think everything is going to be driven by the currency markets. It's the one market that that central banks can't really, I don't think, manipulate like they can the stock market. Central banks have just figured out how to prop up stock markets, how to some extent control the business cycle. With the futures market, they can somewhat manipulate many of the commodity markets to try and keep inflation in check. One thing they can't do, I think, is stop a currency crisis. If your only tool is a printing press, you cannot stop a currency crisis by printing more money. All you can do is shut down the printing press, and as we saw back in 1980, that leads to recession. So I don't think the Fed will resort to that until the situation just becomes uncontrollable with anything less. So my prediction for 2018, serious damage in the dollar index for next year.